Welcome everybody to RedeConnect, and specifically to the session in which we're going to focus on the current secondaries market. By way of introduction, I'm Magnus Goodlad and I lead the transactions team at Rede, which is the firm's principal interface with the secondaries market. I'm very fortunate to have as my guest Gabriel Mollerberg, who has a long and distinguished career in secondaries investment in a series of senior roles at Goldman Sachs Asset Management, where he leads the secondaries team in Europe. GSAM manages more than 2 trillion of assets, including 600 billion in alternatives. The vintage secondary funds were established in 1998 and have invested more than 40 billion of capital since inception. The team is currently investing their 8th fund, a 10.3 billion fund raised in 2019. Gabriel and his team were the most active secondary investors in the market by volume in 2020 and are consistently in the top 3 globally. So he's exceptionally well placed to share his perspective. We're living through a period of significant public market volatility and continuing geopolitical uncertainty. Mark Twain said that history does not repeat itself, but it often rhymes. With this in mind, I remember you saying, Gabriel, early in the COVID crisis in Q2 2020, that hindsight had showed that continuing to invest in the secondaries market through the global financial crisis was the right strategy and one that had been adopted by very few, and that this had informed your continuing constructive view on the market in resilient sectors. This is likely to have served you well in 2020. How have you responded to the current market?
Thank you, Magnus, and thank you for having me today. Very nice to spend the next 40 minutes or so here, talk a little bit about the secondary market. First of all, I would say I totally agree with the intro there you made briefly in terms of continuing to invest throughout crisis. I think that's something, if I look back at our own investing, during the last financial crisis, we felt that we should have invested more, if anything, in the depth of the crisis, and I feel like that is something we fixed this time around. I think secondary strategy is unique in a way that you can capitalize on dislocation also, and there are opportunities coming up from that. There's not always the biggest deals or the most volumes in those years. If you look at the market overall, I think in 2020 it was down something like 30% versus 2019. But if I look at our invested capital, we were actually up about 50%, 50. And the way we did that, I would say, we bought a few portfolios clearly, and we managed to get some good discounts on some of those, but they tended to be smaller transactions generally. It was tough to buy, very large portfolios at those prices. We were very focused though on some of the continuation vehicle deals where I think we could go in and buy very high quality exposures, single assets or more concentrated portfolios at fair prices. And to your point, really finding resilient sectors and invest in. I think anyone trying to sell a portfolio with more impacted sectors in the middle of COVID was very, very difficult. They just wouldn't necessarily be a buyer for that. But there were deals being done in those high quality companies with high quality sponsors in resilient sectors, or many sectors that have had tailwinds. We invested a lot in technology, for instance, in 2020. Really on the back of some of the tailwinds that sector saw as a result of COVID. Food grocery channel is another example. We invested in a big US grocery retailer that year. Again, like they saw something like 18-19% like-for-like growth year on year. Unheard of in a sort of big stable category like that. So trying to find those sectors where you either had resilience or tailwinds. So asset selection, I would say, absolutely paramount. In times of dislocation. We also spend a lot of time in the preferred equity space. Generally we spend time there, but especially I would say in times of dislocation. We felt that we rather probably dial down the risk materially if we can in certain transactions, but still achieve an adequate returns. But you don't necessarily need to be a hero in uncertain times and stretch and sort of take a lot of risk and try to generate very high returns. But if you can get very solid risk-adjusted returns, that is actually a pretty interesting deal type in the middle of a crisis as well. So super active on that side, either on the GP level, with portfolios there, or sometimes with LPs as well, sometimes needing liquidity but not necessarily wanting to sell the whole portfolios. We could provide some liquidity through a bit more of a pref solution there.
Interesting. And do you feel that in the LP portfolio market in general, seller pricing expectations are reflective of the current volatility today, so that we won't see a prolonged hiatus in market volumes?
Yeah, look, if I look at Q1 so far this year, actually we've seen more volumes. We talked a little bit about the continuation vehicles, in 20 and 21 being super active, but so far this year, I would say especially the big traditional portfolios, is where we spent most of our time. They started to come back to the market, I would say, also last year, but that has really continued in Q1 of this year. We've seen something more than 30 billion or so in the market just in this quarter alone. And from what I'm hearing is that most of those deals will close and transact. They will find a buyer. So that's actually pretty astonishing number this year in the middle of all the uncertainty that we have. If you think about the market last year, secondaries was about 130 billion, about half of that, traditional portfolios. So call it, 65 billion, something like that. If the market this year was close to 30, we've already done almost half of last year's volumes in one quarter. I think for some of these portfolios, not always the whole portfolio traded, but certain assets or certain funds within those portfolio traded. So again, brings me back to sort of the asset selection point. I think, if you can find the subsets of funds that are, either have exposures that are more resilient, not as impacted maybe by some of the current crisis that we're seeing, or you've adjusted for price. I feel like, some of the portfolios that we bought in the quarter, we're getting better discounts now probably than we would have, a couple of quarters ago.
Interesting. And have you seen any significant change in seller motivations over the past 12 months?
Yes, there are. I would say, starting with COVID, and increasing, I would say even sort of the last 12 or 18 months, I think we've seen in the primary market, clearly there's been a lot of the sort of increased pace of fundraising has really accelerated, so high quality managers are coming back quicker and quicker. That fundraising cycle is shorter, which means that a lot of investors then as a result, want to re-up with these managers. They've done well for these investors historically, but they haven't necessarily received the distributions yet in some of these younger vintages. So they need some capital or free up some capital to also commit with these managers in the future. So we see, that's been I would say a big trend, in the last year or so, LPs selling to free up some capital from older vintages to recommit in newer vintages, in high quality managers. I think also private equity clearly has performed very well, now for a period of cycle that's led to that shorter fundraising cycle, but also, values have increased in the portfolio. So there's a little bit of what we call a numerator effect. So private equity portfolios look bigger as part of the overall equity portfolios today, because of those reasons. If you couple that also with a bit of a denominator effect, in Q1 with public markets, decreasing in value, again, your private equity portfolio looks, oversized probably to your public portfolio, and that could also drive, sales and with certain investors. So I think you sort of see a little bit of a pressure from both sides, both from the numerator and the denominator at the moment, pushing some of the sales. I'd say another, just like a secular growth clearly in private markets, AUM is continuing to drive sales in the secondary market as well. Today private markets is something like 10 or 11 trillion. If you compare that to 5 or 6 years ago, that was about half the size, 5 or 6 trillion. So you've seen a doubling in private markets AUM, which clearly creates a much bigger inventory. And if you assume the same turnover rate on that, you'll get the same growth clearly in the secondary market as well. So that, that's driving growth. Then there are other reasons that could drive growth as well with certain investors. For instance, you could have personnel turnover, new CIOs coming into pension plans, etc., want to sort of reshape their portfolios. A lot of different reasons as well. But the sort of the big trends I would say are, either private markets, AUM growth, numerator, like funds coming back quicker, value of those funds increasing, not necessarily achieving the distributions because of that, quicker investment, fundraising cycle, and now also more recently, I think a little bit more instability in public markets, and therefore a little bit of a denominator effect again.
And just staying with the macro for a moment, is the inflationary resilience a pervasive lens now through which your investment committee approaches all new investments, particularly obviously on the concentrated side?
Yes, I would say so. I mean, again, asset selection, I think something you can clearly do more easily in a continuation vehicle format, around a single asset. You could buy a software asset, for instance, or, a certain other asset where, you don't have the same exposure clearly to inflation or consumer discretionary spend and things like that. In a bigger diversified LP portfolio, clearly there will be a lot of companies, a lot of sectors. There will be some companies and sectors much more impacted by inflation, in there, or higher input prices for certain businesses. So there, I think it's just important to continue to do the bottom-up work that we always do in some of these big portfolios, value each company and model it appropriately. So you model in some of these inflationary pressures in the business plan going forward, and that's then of course reflected in the price today.
Well, turning now to portfolio construction, you with GSAM have always had a relatively unconstrained strategy with experience underwriting, as you've described, larger LP portfolios, structured and preferred deals, and in GP-led portfolio and single asset opportunities. How have you seen that balance shift, and is this entirely opportunity and return driven?
Yeah, we've actually always tried to keep a pretty balanced mix. So even if you go back to some of our older funds, 10 or 15 years ago, we kept that sort of roughly 50%, traditional LP secondaries portfolios, about 50%, more concentrated or direct portfolios. They've just changed. The types of deals within that sort of more concentrated bucket has changed over the years. We used to do a lot of team spin-outs for many years, primarily where we bought assets typically from banks. Partner with the teams inside those banks to buy those assets and those portfolios, spin them out, set up new independent entities, but where we became the new owners of those assets. I'd say those assets, if I look at those deals in our funds, 10, 15 years ago, they were probably something like 40% of our funds. Now more recently, clearly a lot of those deals are not as prevalent anymore. Like most of the banks that had direct portfolios and wanted to sell them have sold them, sort of including a few years after the financial crisis. Clearly at the same time, sort of about 10 years or so ago, some of the, fund restructuring, so the kind of early continuation vehicle deals really started to kick off. So it's a different deal type today, but it's still a, a GP-led or a GP-partnered deal type where we're partnering with the GP sort of to buy certain assets. So there's a lot of similarities in these deals. It's just the types of the deals, within that bucket has changed somewhat, and they are clearly also more like single asset, GP-led secondaries today. On the market as a whole is probably something like a quarter of the overall market. Last year, as part of that, I think there's also clearly much more front of mind for GPs today. They're thinking about these, types of deals as a portfolio construction tool for themselves. Which is good, which means that the opportunity set clearly widens for us, and we can look at more transactions and really kind of evaluate them and pick the spots where we want to invest. So that's clearly a fantastic development. If you think about it from a returns perspective, it also, I think, is pretty complementary to some of the more traditional LP secondaries that we do. the whole reason to do a continuation vehicle deal, single asset or portfolios is really to sort of allow more time for more value creation. So you're not going to do that if you're buying an asset and then you're selling it tomorrow. It's really to get a little bit of duration and a bit of ROI, in that part of the portfolio. So we're trying to make, 2 times money or more on these transactions. Well, if I look at some of our LP portfolios that we buy, many of them are, older portfolios, a little bit more tail end in nature sometimes, cash flowing very, very quickly. So you're getting repaid sometimes within 12 months, 18 months after you buy, a certain portfolio, very cash flowing. We can then recycle that and reinvest that, either into, more LP portfolio deals or into CV deals, where you're getting a little bit of that sort of cash flow element from the LP side. And a little bit more of the sort of ROI focus from the CV deals, which then blends out nicely at the fund level, from an IRR and money multiple perspective.
Yeah, and if you look at your peer group, Gabriel, do you see more secondary investors seeking to accommodate higher levels of concentration and depth and focus of diligence and conviction in underwriting on the single asset, or do you see sort of caution and holdout amongst some of the larger secondary managers?
Yeah, it depends a little bit, sort of different players. I mean, we certainly do a lot more diligence on some of these more concentrated positions, and the team is very much set up to do that. Everyone comes from that, transactional or direct background. Quite often, I think as part of these processes, there are some, pretty robust DD reports made available. So we can leverage that clearly as part of the process. But if that's missing, increasingly we're also hiring, third-party providers ourselves to help us, with some of the commercial DD, for instance, if there's a sector that we necessarily don't have as much experience in, or where we, we're not as, as familiar. I think some of the other players that have been a little bit more focused maybe on the traditional LP portfolios historically, we've seen them sort of start a little bit also investing into the continuation vehicle deals, but I tend to sort of do a little bit more baby steps, taking smaller positions and maybe, syndicated positions. And if you sort of approach that market that way, some of your underlying exposures might not actually be that different on an underlying company level compared to if you buy like a big LP portfolio. So then you can clearly right size your work, depending on that as well. So I think it varies between players, but I think for parts of the continuation vehicle deals, and certainly how we're approaching them, when we're leading these transactions and taking more material, exposures, there's clearly a lot of work that goes into, those transactions.
I can testify to that.
Yeah.
And on the overall portfolio construction, are you cautious on over diversification and indexing in portfolio construction, or do you look at things more broadly?
Yeah, first of all, I think the diversification is super important for a secondary fund. Like you should never really go away from that, because that's, I think, one of the key features of a secondary fund, and that you can lower the risk also through that, increased diversification. But diversification does not always mean like indexation, though. That those are two different things. I think you can still be diversified, but pick interest in the right companies in the right sectors that will drive performance, but do it in a risk managed and diversified way. Historically, I would say returns in the secondary market has been relatively bunched together. I think we might start to see a little bit more dispersion in returns among secondary funds as a result of the market evolving also into some more concentrated continuation vehicle type deals. We'll see. That'll be interesting to follow over the next 5 or 10 years. But we're trying to find a balance there by taking positions where we have conviction, that can have an impact on fund performance as a result of that, but also clearly not overexposing ourselves to single assets, but sort of avoiding becoming an index at the same time.
And you referred earlier on the buy side to tail end portfolio purchases, but the tail end portfolio sales have become increasingly frequent amongst secondary managers as part of your overall portfolio management. Do you think that's a trend that's here to stay from an IRR perspective?
Yeah, absolutely. I think it makes total sense, and it's good sort of portfolio management to do that. We buy sometimes from other managers. We sell some of our own tail end exposures to some of our competitors as well. So I think it's just part of the ecosystem now that, you have to manage some of these tails. At some point it clearly just makes sense to wind up a vehicle. And yes, you'll have to take a pretty material discount then on the portion that you're selling. But I think the reason also why we sometimes, like buying these portfolios is there are just other, motivations at play there than just maximizing economic value. And necessarily if you're selling something like year 13, 14, 15, something like that, after you made those investments, you're selling maybe the last few percent, 4 or 5% of your total cash flows. So even if you sell that at a 30 or 40% discount, it won't actually move the needle on your total fund return. At that point, you will have locked in your money multiple and your IRR already for a long time ago. So that's a good seller actually to transact with from a buyer's perspective, because if you can solve the problem and transferring all these hundreds of interest in one transaction, you can usually get rewarded for it and get a reasonably good price on entry. In the same way, sometimes we know that when we sell some of these older vehicles, of course, if we had kept on holding them, we would have achieved higher value, but you reach a point in a fund's life where it doesn't make sense anymore.
Another portfolio management question for you, Gabriel, which is on the use of fund level financing facilities within secondary strategies. Do you see that as being a helpful way to accelerate liquidity and enhance returns?
Yeah, I'd say, secondary funds clearly are well suited for some of these facilities. They're clearly just given the diversification in these funds and the lower underlying leverage that you have, given the assets that we buy are more mature, EBITDA typically would have grown since the initial buyout was done and debt would have been paid down somewhat. So that there's kind of lower underlying leverage there versus, a primary buyout market. So I do think it makes sense from that perspective. We've never been a group that sort of maximized leverage though. Historically, we were actually rather under leveraged versus the market. Lately what we have done is that we offer investors actually a choice to go into 2 different products. One product like that with much less leverage than the overall market, and then what we our flagship vehicles that will target more market levels of leverage. So we think it makes sense to give investors the choice, but yeah, no, absolutely, I think it makes sense also at the fund level to have some of these facilities to stay competitive as well.
As you're aware, Rede has developed an extensive practice advising primary managers on implementing NAV facilities, and we're having a separate section in RedeConnect on that. But it'd be interesting to get your perspective. We see other LPs who've increasingly migrated from caution over the use of these facilities to, in certain circumstances, selectively participating in them. In the right context, are you generally supportive of managers using these kind of structures in funds where you're invested?
Yeah, I think it's just a natural evolution of the market. I think part of it is clearly you can manage cash flows through sublines, but also at some point, doing a NAV facility. As I mentioned, secondary funds have been using them. Clearly they have also some of the diversification benefits. But I think also in the primary fund market, we're starting to see more and more of them being used. You clearly just have to be aware of it clearly, when we as buyers in some of these funds, when we underwrite those funds and look at the impact of the leverage, and sometimes there's a little bit of education you need to do there with the seller, where there can be a relatively small movement in valuation, means a more meaningful impact on the cap account and the discount because of some of that leverage, at the fund level. So you have to educate and work with the sellers on that. But yeah, no, I think that's definitely here to stay, and I think we probably will see more growth in that part of the market as well.
And it'd be good to move now to talk about the credit secondaries market overall. And we know a number of larger LPs and specialist secondary managers have been seeking to build their credit secondary capabilities and establishing dedicated teams and funds respectively to focus, reflecting the strong growth in the primary credit markets. How do you at GSAM see the credit secondary market developing?
Yeah, look, I think the luxury we have in the secondary market more broadly is that we can just look at the primary market, right? For be it credit or infrastructure or real estate or whatever is part of the market, and we can see the growth there, and then we can sort of make certain assumptions and apply a few years lag, and you get to reasonable, accurate growth forecast in the secondary market. And there, if I look at the primary credit markets, clearly the private credit funds that have been raised over the last decade, 15 years, especially after the financial crisis, and them taking more and more share in the lending markets, clearly will drive growth also in credit secondaries. There is also, I think, a little bit of a mismatch in some of these funds, where the fund's lives don't necessarily match up to the duration of the underlying assets. So there is a need for a secondary solution there. So it's an area where we're absolutely watching. We invest in credit secondaries as well. We have some people on the team they come a little bit more also from a credit background that spend a lot of their time on that, but also on the sort of more preferred equity space, which straddles a little bit clearly between credit and equity. But a lot of the thinking and the sort of structuring is actually quite similar.
And other structural tools like evergreen vehicles or enhanced recycling within closed-end funds, which you can see supporting the growth of this market and wider access and return enhancement?
Yeah, I think you absolutely, you need the sort of recycling element in that strategy. I think otherwise, some of the ROIs could be a little bit challenging. So definitely recycling. I think evergreen, I mean, there's been sort of broader discussions on evergreen anyway, kind of in private equity as well. We haven't seen like a huge shift in migration into evergreen. I think still like vast majority is just, the classic sort of fund structure. So I don't see that necessarily impacting also credit secondaries, massively. But I do think the recycling is, is very important.
I thought we turned to talk briefly about the venture market, where the primary market has been through a period of sustained and strong growth with more capital raised by venture managers than infrastructure managers in 2021. Rede advised on a successful venture strip transaction in 2021, but it remains relatively underrepresented in larger secondary manager portfolios and more, but not universally, the domain of specialist managers. Can you see this changing as the primary venture market deepens?
Yeah, no, absolutely. I think that you have the growth in the venture markets, as you say, clearly, over the last decade. I think the other trend we're really seeing is that, venture companies are staying private for longer and longer. But there's still a need for liquidity. So if you compare to the sort of IPOs of some of these technology companies today versus 10 or 20 years ago, they're much bigger in size. They reach to multi-billion-dollar companies before they IPO. But there is a need for liquidity along the way before that liquidity event. So makes absolutely sense that the secondary market is there to provide that liquidity either to early investors in the fund, could be employees in some of these companies, that have pretty meaningful share positions as well. So we do spend quite a bit of time on venture as well, and we have a dedicated team within our broader team also with a background more in technology investing, that really drive that effort. Clearly, as a bigger fund, even if let's say we employ something like $1 billion in venture, that would only be about 10% of the fund size. So it will never be like a huge portion of the fund, but I think it is a growing portion and an increasing portion as well, just on the back of the growth we've seen in the primary venture markets.
And turning to another part of the market, emerging markets, both primary and secondary in private equity, have been through a prolonged drought. Do you see any prospects of that changing in any geographies or sectors in the near term?
Yeah, I don't think anything will change overnight here. I think it will take some time. It takes time, first of all, to build up, strong portfolios. On the primary side, some of the GPs take time to sort of create the track record and sort of experience in these regions, strong management teams, at the underlying, portfolio company level, etc. these all takes time. So I don't see sort of a watershed moment and all of a sudden, it's becoming a very meaningful part of the overall market. We've always done, some of that as part of our funds, but I think it's fair to say that the bar is, pretty high in some of these regions to compensate for some of the risks that you take, also outside of your own control, macro risks, currency, geopolitical events, clearly like creating turmoil and limiting, exit options, for some of these companies in these regions, etc. So, I think it's a part of a portfolio, but you really need to see higher returns to make it worth your while.
And if we turn now to talk about the participants in the secondary market, as the market's grown, it's inevitably attracting new entrants as well as changes of ownership in a number of the existing participants. Can you see the respective market shares of the current cohort of specialist managers, new entrants and asset owners shifting materially?
Yeah, I think what's interesting, with the secondary market, even though it's become, a very large market today, actually, it's really the same large players today as were there, 15, 20 years ago when the market, really started. So we haven't seen like big new entrants. Of course, there've been funds raised along the way, but we haven't seen, if you look at the top sort of 6, 7, 8 players in the market, those would be the same players that were there, 15, 20 years ago. And I think the reason for that is, barriers to entry in secondaries are very high. Especially I would say for some of the traditional secondaries where you need a big platform, you need big database with all the information, you need all the relationships with all the GPs and the funds that you value, you need to be an investor in all these funds, have all those relationships. So it's very difficult to set up shop from day one and start doing, some of these bigger transactions in a big way. It takes a long time to grow and get to that scale, and it's not 1 to 2 years. I think it's like 10 to 20 years, to get to that scale and get to that level. And I think that's why we've seen so much M&A in the sectors, because clearly as the secondary market has become larger and on the radar screen for a lot of these, bigger private equity firms or asset managers, you really need to acquire someone to become a meaningful player more quickly. It's very tough to build it from scratch, or it takes time to build it from scratch. So I'd expect continued M&A as a result of that. I think over a very long time, you might start to see that concentration come down a little bit as some of the smaller funds will gradually, raise larger funds and become a bigger part of the market. But again, it's not sort of a 1 to 2 year thing. I think it's a 10 to 20 year development.
And if we turn to the GSAM team for a moment, are you looking to recruit more talent with direct investment experience and encouraging strategy specialization within your team, particular GP-led focus?
Yeah, we've actually, I would say already the existing team have that background, but I think even more importantly now, people that we're hiring, are coming from that background increasingly. What we did a few years ago is to, introduce, more of a vertical organization within our team. So there's certain people responsible for the big LP portfolios, certain people are responsible for some of the GP-led deals, certain people responsible for preferred equity or more structured solutions, etc. And I think that has really made a difference in how we work, and we can process many more deals as a result of that. We are much more efficient in how we work today as a result of that. So I would say that's how we adopted to the market, starting a few years ago, and I think we'll continue to do that going forward as well.
That makes sense. And what do you see as being the core differentiation for GSAM and the deals where you've been successful, particularly very competitive ones?
I'd say quite often it just comes down to relationships. It could be relationships with the seller, relationship with a particular GP, either in a GP-led or even if you buy a portfolio from a seller and those names, you have good relationships with the GPs. So relationships absolutely super important. I think coverage, in some of the big diversified portfolios, making sure you have, value these funds, before they, hit your desk. I think more and more of these transactions are quite short in timeline. So if you haven't done your homework before the transaction kicks off, most likely will not have time to value all the funds and be there and submit the price. some of our primary team relationships, I would say has clearly helped us over recent years. Goldman invests something like 2.5 billion every year out of different primary pockets than the secondary funds and a different team. But clearly we can leverage their relationships and find opportunities also in some of those names where they are investors. Just sort of a deeper knowledge of the portfolio in some of these situations, clearly like trying to find situations where maybe there are certain assets in a broader portfolio where we know that some of our competitors might not be in that particular name, or we know that portfolio better than others, and trying to sort of buy those names, but also create more of a portfolio around that. I think those are situations where we've been successful in the past typically.
Would you say there's still such a thing as proprietary deal flow at the larger end of the secondaries market?
Look, I think if somebody is selling a 500 million portfolio or $1 billion portfolio, most likely, I mean, it can happen, but most likely they will hire an advisor and they will go to the market and at least, price check with a few folks. So yes, I think it's rare. Doesn't mean like we as a larger fund sometimes do proprietary deals, but they tend to be sort of smaller or mid-sized deals that we find, maybe a single LP position or something. We're very happy to pick up also smaller positions as part of our overall strategy. But I think for a very large portfolio, it tends to, in most cases, be, intermediated. So it's more about, in those situations, I think finding your angle and, as I talked about, maybe leverage certain relationships, maybe more difficult to transfer names where the GPs are quite restrictive on transfer, trying to find those opportunities where we are, an approved buyer in those names, or we have knowledge over certain assets, etc., in those portfolios.
If we just turn for a moment to look at overall secondary market growth, you've seen the sort of parallel and clearly linked trends of growth in private equity investment and the use of the secondary market for portfolio and liquidity management that we've talked about. And it was a very strong secondary year in 2021, albeit in the wake of, as you described, it was a lower deployment year in 2020 and a strong fundraising year for the secondary managers, leading secondary managers. If you look forward 5 years, what percentage of the private equity market do you believe will be the subject of secondary transactions, and what could lead to that figure being either missed or exceeded?
Yeah, look, I think, if we start by, looking at the primary markets, so I mentioned earlier that that's today like a $10-11 trillion market, something like that. Secondary market last year, about 130 billion. So, call it 1% or just over 1% of the sort of total inventory gets traded in the secondary market every year. So you're still really only scratching the surface actually on the overall, bigger primary private equity market or private markets, across, asset classes. So I think even quite small changes in that turnover rate can create very different, developments in the secondary market. And we talked about some of the reasons, I think, why the secondary market now is growing faster than, some of the primary market growth. And I think some of those trends are absolutely here to stay. I think I'd expect the continuation vehicles to continue to grow. I think they're much more front of mind for managers today. They view it as a very interesting tool in their toolkit, sort of as for their overall portfolio management of a portfolio. People want to hold on to their winners for longer, create more value, and sort of extract more value out of those companies. I think more and more GPs in their careers have seen, I had this great company, I returned 3 or 4x on it, but then I sold it to my competitor down the street, and then they made 3x over the next 4 or 5 years. Like, well, shouldn't I keep some of that value creation myself within the organization rather than give it away to my competitor in a way? Like, there are certain assets in the industry that just keep on performing. Finding those assets, I think many of those assets will go into continuation vehicles. LPs clearly can then decide, do I want liquidity in that particular asset because, it's a fund where I've invested for, the last 7, 8, maybe 10 years. I need to take some money off the table. Maybe I roll a portion, maybe I take some money out, or I roll everything, But I think having that choice, I think, is important for LPs clearly, but also I think for the managers, it's an important development because they can, keep some of that value creation in-house, for longer. So I think that trend is absolutely here to stay, and who knows how big that could become. I think that could become pretty meaningful part of the overall secondary market, and probably lead to maybe less secondary buyouts, sponsor to sponsor transactions. If you look at it in extension, it might be many more sort of continuation vehicle deals on the single asset side as a result of that, and less sponsor to sponsor deals if it's 5 years from now.
I'm conscious of time, so we should just close with a final outlook from you. It'd be great to hear whether you see there are any shorter or longer term clouds that you can potentially see on the secondary market horizon that we should be watchful for.
Yeah, look, I think the overall structure of the market, we talked a little bit today about the sort of supply demand that we see in the market. I wouldn't say there's any clouds in the market. If any, like the supply demand balance, I would feel is very adequate. If anything, actually, the buy side probably hasn't been able to raise capital quickly enough to sort of support even further growth of the secondary market. We're in a luxurious position in a way as buyers to be able to pick and choose between a lot of deals and a lot of supply. And if anything, the sort of demand side, the buy side has been a little bit constrained over, last years. And if you look at all the metrics, of dry powder versus, annual deal volumes in secondaries, they're much, much lower. They're probably right now just on 1.5, maybe 2 times, even if you include some of the fundraising that's being done in the market today compared to annual deal volumes. Very different metric than the primary market, which is at, 4 or 5 years. So I think I'm not worried about the sort of supply demand characteristic. I think that's, very robust and very solid. If I think about risks or clouds, I'd say it's very much the same as private equity more broadly, or even just, being a long only equity investor. So macro rates, inflation, geopolitical risks, valuation multiples coming down clearly. All of those factors. I think on the valuation multiple front, at least, within the secondary strategy, you do have a little bit of a cushioning to that, given we buy at discounts, on average, to the sort of book values in some of these funds. So there is a little bit of a cushioning effect, and I think therefore quite a useful tool for investors to sort of average down or help lower their valuation exposures in their overall private markets portfolio. But of course, at the end of the day, like it's correlated with public markets and primary private equity market valuation multiples as well. So those are some of the things that we talk about at RIC every week. More so than probably secondary market not functioning or risks in the secondary market or too many entrants or too much capital or things like that. We're not as worried about. It's probably more like macro and other, or of course like company specific issues on a particular investment you evaluate.
Very sadly, that's all that we've got time for today. So all that remains is for me to thank Gabriel on behalf of Rede and all our RedeConnect audience for a characteristically insightful perspective. Thank you and goodbye, everybody.
Thank you.